Hey, what's going on? This is Big Ben, and in this video, we're going to go over another setup. Now, this setup is called a bank trap or a trap, and the reason why it's called a bank trap is because allegedly banks or the big dogs love to take out stops in the market. So a lot of times, people love to put their stop loss above a swing high, a swing low. And the market loves to go up, take those stops, stop people out, and then reverse back down. So let's show you a good example of what I'm talking about. So basically, when price is trying to make a high, right? So this is the high, right? And the price pulled back, and then it made a high. Now, if you notice that when price went above this candle right here, notice that price couldn't close above this high. So you have to understand that this candle right here went all the way up to right here, and then it went all the way back down. So this level, the high of this candle right here, price couldn't close above this level. So usually that means that it's weak, and the buyers can't really push this thing up, and usually the price reversed. So this time price only reversed just a little bit, and then we start to go back up. And remember, everything is not 100%. Everything is not 100%. Okay, so let me show you some more examples of here's another one. Price went up, try to make a new high. It closed below this bar right here, but if you notice, price never went below this bar right here. So this is the setup bar right here, and you will enter as soon as price goes below the bar that couldn't close above this high. You will enter below this price. Now the market couldn't go below this candle bar, so you wouldn't enter that trade. So the next one is price went up, pulled back, and then made a new high right here, and then we created a nice engulf bar, and then we start to go down. So this is a perfect setup right here. Now here's another one, even better. We made a high, we pulled back, we went up, try to make another high, but it couldn't close above this high right here. We went up, but the candle went all the way back down. It closed right here. You see it closed right here. We couldn't make a high, and we actually made a high, but we couldn't close above this high. And guess what? We reversed right back down. So this is a trap. We call these traps, and basically you can actually use these setups to get in the market. And if you notice, this is a little one right here. The market went up, pulled back, and went up again. If you notice that it couldn't close above this level. You could go short below this, and the market, you notice the market basically went down. So let me zoom out and show you some more setups. We have one right here, but to be honest with you, you really want to take trades that's actually at the EMA or either near it. You don't have to go exactly next to the EMA, but as long as is at a good situation. So if you notice that price went up enough for you to actually enter in the trade. Now, when you are way below the EMA, you really don't want to take trades, because remember, price is like a rubber band. So when it starts to travel down, eventually it's going to bounce back up. You really don't want to take trades when the market is going down and it's right around here. You want to pull back to at least either near the EMA or a little bit below the EMA, and that's when you want to look for setups. So that's one setup that you can actually look for. Let's see if we see it on a daily charter. Okay, all right. Let's see. I think I saw one. Yeah, here we go. Right here. Right here. So let me zoom in. Okay, so this is the high. Price went up. You see it couldn't close above it, and then this is actually recently. Price was going down, and then made this move. So keep in mind that this is a good setup and definitely will help you get in the market. So I will meet you in the next video, and we will talk about the last setup.